over the past 5 years, the total return of your average bond fund has been negative. So that has not done much in the way of proper diversification of a portfolio, especially if you're in a 60-40 kind of allocation. Bonds have really not been pulling their weight. So it becomes really important, especially as you get to higher asset levels. And I like to think, if you have more than 2 or 3 million in net worth and liquid net worth, what's really important is to think outside of just your public stock and bond mix, because when you look at the entirety of the market, publicly traded stocks and bonds are actually a very small portion of what's out there to invest in. Publicly traded stocks, it never fails to amaze me that when you think about how many are out there, it's been shrinking over time. I think there's only like 4,000 publicly traded stocks these days. There aren't hundreds of thousands like you might think. So even if you invest in every single one of them, that's very limited diversification. The other issue that we've seen with a lot of clients is that they've held certain allocations for a very long period of time without rebalancing them, making sure that they're diversified along the way. So they have these concentrated positions that have outgrown a little bit of their welcome. And now they're this ticking tax time bomb inside of the portfolio. You don't want to sell it outright because you're going to pay a ton of capital gains tax. But at the same time, it's overweighted in your portfolio. And if something happens to that one company, that changes your entire financial picture.